Rents are falling, so what does that mean for the housing market? Sounds great, right? Are we entering an era of affordability, or is this just a temporary reprieve? And what about the homeowners, investors, or those looking to buy their first home? Today, we're breaking down the latest data from a few news articles that have been out over the last couple of weeks, unpacking some expert insights and exploring what this might mean for you, whether you're renting or buying or just trying to make sense of it all. So let's get started. If you're new here, I'm Cameron Brioux and I'm a realtor in Moncton, New Brunswick. If you have specific questions about the New Brunswick market or want to connect about real estate, you can head down to the first link in the description and book a call with me. Okay, so here's the headline. Average rents in Canada ended 2024 down 3.2%. Went on to read that hitting a 17-month low of $2,199. And it's the first meaningful drop in rents that we've seen in years. And for renters, it's huge. Houses and townhomes have saw the biggest drop at 7.4%, followed by condos, which were down 5.2%. But let's not get too excited just yet. Rents still vary dramatically depending on where you live. For example, in Ontario, the average rent is $2,332 per month. In BC, it's even higher at just under $2,500 a month. Meanwhile, Alberta does offer some relief with average rent somewhere around $1,700. But it's still a wide gap from my area of Moncton, which is reporting a median rent of $1,350. So what's behind these numbers? A surge in rental supply. Developers are finally catching up to demand, and that's creating some breathing room for renters. And I know, you're probably asking, what about the home buyers and what about the investors? To understand that, we'll need to dig a little bit deeper into the data. On our way there, let's talk about the age-old debate, renting versus owning. According to an analysis by Zoocasa, in many Canadian cities, renting is the more affordable option right now. For example, in Vancouver, renting a comparable home saves you about $2,300 per month compared to owning. That's about 44% less. In Toronto, the savings are about $1,900 per month. However, in smaller cities like Winnipeg and Saskatoon or St. John, the financial gap between renting and owning is much narrower. So why the disparity? A lot of it comes down to interest rates and home prices. Sean, a senior economist with CREA, recently explained in an interview that while mortgage rates have started to stabilize, prices are already rising in most provinces, except for BC and Ontario. Sean said, and I quote, "Prices are already going up everywhere except for BC and Ontario. The trend is already underway." The key takeaway, lower rents don't necessarily mean housing costs are getting cheaper across the board. Home prices, particularly in competitive markets, are still climbing. Let's shift gears and talk about supply. Rental supply is at an all-time high, which is part of the reason that rents are falling. But you're probably asking, what about housing supply? And according to Daniel Foch, the chief real estate officer at Valerie.ca, is quoted in saying the increasing cost of owning rental properties with things like rising property taxes in cities like Toronto may force some landlords to sell their units, which will add more supply to the housing market. Daniel also made an important point when he said, and I quote, "We probably have continued downward pressure on prices and rents for the foreseeable future. For homeowners, that could mean more competition. For renters, it could mean better deals. And for investors, it's a moment to reconsider strategies, especially in cities where rental properties may no longer make financial sense." Now, let's talk about affordability. This is where things get interesting. On one hand, mortgage rates have come down, making it slightly easier to finance a home. But as Sean pointed out, and I'm quoting here, your ability to finance it might have shifted a little bit, but the price has gone up. So you're not saving anything. It's a frustrating paradox. Rates drop, but prices rise, keeping affordability essentially flat. And other factors like rising wages, economic uncertainty, and even the possibility of a recession. And it's clear that affordability isn't just about rates and prices. It's about the bigger economic picture. So, what does this all mean for you? If you're renting, this could be your moment to negotiate within your lease. More supply means more landlords are under pressure when units come available to rent. So, that could be used to your advantage. On the flip side, mom and pop investors could simply decide to sell. For buyers, it could be a mixed bag. Yes, rate drops are more stable, but prices are creeping up in many markets. And for investors, this is a critical time to evaluate your portfolio. Rising costs like property taxes and maintenance may push some properties into negative cash flow. Daniel summed it up well when he said, "You could continue to see affordability if trends in rates, prices, and wages stay balanced. But if any of those factors shift, like prices climbing too quickly, affordability could evaporate just as quickly." As we head into 2025, the big question is, will this balance hold? Experts like Sean and Daniel agree that the best case scenario is a market with more transaction volume but no massive price spikes. In other words, a healthier, more sustainable market. So, whether you're renting or buying or investing, staying informed is certainly your best tool. Watch the trends in your local market, look for opportunities, and make decisions based on your long term goals and not just the headlines. So, what do you think? Are we heading more towards a balanced market in Canada, or do you see more turbulence ahead? Let me know down in the comments below. I'd love to hear your thoughts. And don't forget to subscribe to this video. Thanks for watching, and I'll see you in the next one.